Hi everybody, and welcome back to video number 2 in chapter 14. And when we left off, we were looking at manufacturing costs and the components of manufacturing costs. So our product cost here is going to be comprised of direct labor, direct material, and factory overhead that we discussed in the prior video. Period costs are non-production costs that are linked to a time period, not products. Examples of that would be selling expenses. These are costs necessary to obtain orders and deliver finished goods to customers. And general and administrative expenses are costs of staff support and administrative functions, such as the wonderful accounting staffs and human resources staffs. Okay, so if we look at these product costs then here for bicycles, we have our direct costs that we talked about earlier and our indirect costs that we talked about. But our period costs are selling expenses, including advertising, promotional materials, salesperson's salaries, salesperson's commissions, salesperson's travel, and maybe even a salesperson's smartphone. The general and administrative expenses would include our office accounting, distinguished from factory accounting, and office employee wages, office rent, office equipment, depreciation, office insurance, and of course, our office managers' salaries. So those are the distinctions between product and period costs. Okay, so this is how we would put this all together. Here in year 2001, we have our period costs, our expenses, and our product costs. Product costs are generally inventory. So inventory that's sold in 2021 will roll into cost of goods sold. The period costs will be reported in the month, usually, that they occur, the selling expenses and the G&A expenses in our income statement. But the inventory that's not sold remains in inventory, and that inventory can be raw materials inventory, work in process inventory, or finished goods inventory. But eventually we will sell that inventory, and it will appear in the next year's income statement. Okay, very important to note that oftentimes we are going to incur expenses in building that inventory that is not going to be reflected in the income statement until it is sold, right? It stays in inventory and on the balance sheet. So there's a delay oftentimes in reporting those costs and expenses. All right, cost concepts for service companies. Now, we describe that mostly in financial accounting, but service companies can classify their costs as direct materials, direct labor, overhead, selling, or G&A, general and administrative costs. So let's take a look at what an income statement looks like and a balance sheet looks like for a manufacturer. Again, we have our raw materials inventory. Those are materials that are waiting to be processed. Work in process inventory is when we requisition that material out to the plant floor and begin to complete our products. What remains in work in process are partially completed products, and they will include some materials, some labor, and some overhead that's been added to that point, but have not yet been completed as a finished good. The finished goods inventory, we're going to move finished goods from work in process inventory into finished goods inventory when they are completed products ready for sale. Okay, that's the flow of inventory in a manufacturing company. So when we look at balance sheets for manufacturers, merchandisers, and services, here is a service company, Northeast Air, right? And you'll see that they don't really have anything that would be considered a inventory. They do have some supplies, but generally speaking, service companies don't have inventories. But merchandising companies, in this case, Telemart, they do have merchandise inventory. Merchandising companies purchase from a manufacturer a completed product, put it on their shelves, and then we go in and purchase that merchandise as a finished good. Now, manufacturing companies, as we just went through, have raw materials, work in process, and finished goods inventories. Okay. The primary difference on balance sheets for manufacturers, merchandisers, and services, therefore, is inventory. All right. This is a very important little formula here. Here we have beginning inventory. We add the cost of merchandise purchased, back out the ending merchandise inventory, and that tells you what the cost of goods sold is going to be. But in this chapter and in this course, we'll mostly focus on manufacturing companies. And they begin with beginning finished goods inventory. That's after they've gone through the raw materials and work in process and been converted into a finished goods. We add the cost of goods manufactured to that, back out the ending finished goods inventory, and that's going to be our cost of goods sold. So this is a very important slide. A service company doesn't have any of those issues. A merchandising company would have one kind of inventory. They have merchandise inventory beginning, they purchase some inventory, that gives them their cost available for sale. We back out the ending merchandise inventory, and that gives us a cost of goods sold. We covered that in the Financial Accounting 1A course. But now, as we look at manufacturing companies, here our cost of goods sold starts with our finished goods inventory beginning here, and then the cost of goods manufactured. That's going to be the cost of goods that gets transferred in from finished goods, from work in process inventory to finished goods inventory here. And that gives us the goods available for sale. We back out the finished goods inventory that we have at the end of the period, and that gives us our cost of goods sold. Okay. Now, let's take a look at explaining manufacturing activities and the flow of manufacturing costs. Here, we're building bicycles again. So here's our raw materials activity. And they're showing some spokes and some tires and some sprockets and those kinds of things. Those raw material beginning, we purchase some raw materials. That gives us the available materials. And if we then requisition them in to work in process. And so those raw materials will go into the direct materials that we use directly on the line. But there's some materials that we that are unused direct materials. And those little beauties stay in the ending inventory for raw materials. Now, what's not shown here is that additionally, we have direct materials used, but we also have some indirect materials used, and those go into the factory overhead pool, as I call it. All right, now, now all of the work in process beginning inventory plus the direct materials we use, plus the direct labor that we use, plus all the factory overhead that we use, including indirect materials and indirect labor, go into the cost of that finished good product. And when those goods are finished, they are part of the cost of goods manufactured. But again, the unfinished go into the work in process ending inventory. Now we have finished goods inventory beginning. We added the cost of goods manufactured. And now if we sell it, those finished goods, they become cost of goods sold. If we keep it, it stays here in finished goods inventory ending. So one of two things happen to those finished goods. We either sell it or we keep it. If we sell it, it's cost of goods sold. If we keep it, it's ending inventory. Okay. Now let's take a look at preparing a schedule of the cost of goods manufactured and explain its purpose and links to the financial statement. Here, this is a summary of the types and amount of costs incurred in a company's manufacturing process. So we pick up the direct materials used, the direct labor that we use, and the factory overhead that we use. And that factory overhead includes things like utilities and rent and those kinds of things, but also indirect materials and indirect labor. And that is the total manufacturing costs. Now, we have beginning work in process. We're going to add that to the total manufacturing costs that we incurred that month, back out the ending work in process, and that gives you the cost of goods manufactured. Very important definition. Okay? So this is the cost of the goods that we have manufactured in work in process inventory, and those costs then get transferred to finished goods inventory. And this little manufacturing statement explains all that. Here's our direct materials. So we start with our raw material inventory beginning. We add the purchases. That gives us our available raw materials for use. Now, our ending inventory is $9,000. That means that we moved $85,500 into work in process inventory. The direct labor was $80,000. But the factory overhead, that's going to include indirect labor, and they don't show it here, but it would be indirect materials as well. Factory utilities, repairs on the factory equipment, property taxes, depreciation expense, maybe rent and utilities and that kind of thing. And that totals $30,000. So we add those three pieces together, direct materials, direct labor, factory overhead, and that comes out to our total manufacturing costs of $175,500. Then we add our work in process beginning to that, back out and that gives us our total cost of work in process. We back out the work in process ending inventory, and that gives us the cost of goods manufactured. That looks like a good place to stop this video. And when we return, we'll take a look at some key calculations. Until that time, bye for now.